If you're 60 or older and collecting Social Security or any kind of retirement income, pause for a moment because something just shifted in Washington that could directly impact how much the IRS ultimately takes from your payments. Most seniors haven't heard a word about it yet. Bernie Sanders has now spoken up, and his remarks on the Senate floor have stirred concern across both political parties. There is a proposed IRS rule adjustment moving quietly through the system right now. No major headlines, no primetime breakdowns, just policy decisions being shaped behind the scenes that could cost retired Americans thousands of dollars they already earned and paid taxes on. We're talking about potential changes to how retirement withdrawals, pension income, and Social Security benefits are reported and possibly taxed as soon as next year. Sanders is no longer staying silent, and frankly, neither should you. Because here's the reality that rarely gets explained clearly. Seniors who understand these developments early have a real opportunity to safeguard their income before any changes take hold. Those who remain unaware may only discover the impact when they open a larger than expected tax bill. In this video, we're going to break down what this proposed shift actually means, what Sanders specifically said, and the 3 steps financial professionals are urging anyone over 60 to consider right now. You spent decades earning this money. Don't let a policy adjustment quietly reduce it. Hit the like button so more seniors can see this information while there's still time to act. Let's spread awareness. And before we go further, understand this clearly. This is not about politics. It doesn't matter if you voted Democrat your whole life, supported Republicans, or stayed out of elections entirely. What's happening within the IRS affects every retired American, regardless of political alignment. So settle in, focus, and let's walk through what's actually happening, because this is one of those situations where not knowing the details can cost you real money. Let's begin with Bernie Sanders, because his name is at the center of this conversation, and many people are asking what he actually said and why it matters. Sanders, the longtime independent senator from Vermont, who has spent decades advocating for working-class Americans and retirees, recently stepped forward and made a very direct statement about where the IRS appears to be heading. Now, he has never been someone to hold back his opinions. For years, he has stood at podiums saying things others avoid. But what's different now is that people across the political spectrum are paying attention, because what he's pointing to affects millions of seniors living on fixed incomes. What Sanders explained in straightforward terms is that the IRS has been gradually reshaping how it evaluates, monitors, and potentially taxes retirement income streams. Specifically, the types of income that seniors depend on most. That includes Social Security benefits, 401k, withdrawals, pension income, IRA distributions, and even certain annuity payments. These are not luxury earnings. These are the financial foundations seniors built over decades of work. And now, adjustments moving through the system could change how that income is tracked and how much of it remains in your pocket. Now let's be clear about something important, because there is a lot of confusion online. This is not about the IRS suddenly targeting seniors with aggressive enforcement actions or knocking on doors. That's not the situation. What this represents is something quieter, but potentially more impactful. It's a gradual administrative shift in how retirement income is classified and analyzed. And those kinds of shifts can create real financial consequences for people who are not actively paying attention or who don't have guidance navigating the system. To understand this better, we need some context. For decades, Social Security taxation has followed a structure established in 1983 and later adjusted in 1993. Under that system, up to 50% of your benefits could be taxable once your income crossed certain thresholds, and up to 85% could be taxable at higher levels. Here's the key issue that rarely gets discussed. Those income thresholds have never been updated for inflation, not once. When they were introduced, they reflected the economic reality of that time. Today, after decades of rising costs, inflation, and increasing living expenses, far more seniors are crossing those thresholds. Not because they're wealthy, but because prices have gone up while the threshold stayed frozen. This is known as bracket creep, and it has been quietly affecting retirees more each year. The concern now is that newer IRS adjustments may add even more complexity to an already complicated system. and complexity almost always works against the average person. When rules become harder to understand, mistakes become more common. When mistakes increase, penalties follow. And when penalties increase, more money leaves retirees' pockets and flows back to the government. This isn't about conspiracy. It's simply how complex systems tend to function. And Sanders is one of the few voices openly highlighting this pattern. One major focus area involves something called provisional income, which determines how much of your Social Security is taxable. This includes your adjusted gross income, any tax-exempt interest, and half of your Social Security benefits combined. As reporting requirements evolve and definitions tighten, more seniors may unknowingly cross thresholds that increase their tax burden. For someone living on a fixed income, an unexpected tax bill isn't just frustrating. It can mean cutting back on essentials like medication, groceries, or utilities. The impact is very real. Another major factor is required minimum distributions, or RMDs. If you have a traditional IRA or 401k, the IRS requires you to begin withdrawing funds at a certain age. That age has already shifted due to legislation like the Secure Act and Secure 2.0. The principle is straightforward. Taxes were deferred for years, and eventually the government collects. But the interaction between RMDs, Social Security taxation, and Medicare premiums creates a ripple effect that many retirees don't anticipate. For example, a retiree begins taking RMDs from a long-held IRA. That withdrawal increases their income. That higher income pushes more of their Social Security into taxable territory. Then, if income crosses Medicare thresholds, their Part B and Part D premiums rise due to IRMA. One action triggers multiple financial consequences. With the IRS refining how these figures are tracked, the margin for error becomes smaller and the financial impact larger. Sanders has argued that this layered pressure reflects a failure to modernize policy for today's retirees. He has pushed for reducing or eliminating Social Security taxation for lower and middle income seniors. He has also questioned how the IRS allocates enforcement resources, especially after receiving additional funding through recent legislation. A key concern is whether enforcement disproportionately affects average Americans rather than high-income individuals with complex financial structures. Historically, lower and middle-income taxpayers have often faced similar or higher audit rates simply because their returns are easier to process. This creates a system where ordinary retirees may face more scrutiny than individuals with far greater financial complexity. So what can you actually do? That's the most important part. Financial professionals who specialize in retirement planning consistently recommend starting with one key step. Know your provisional income right now. Calculate your adjusted gross income, add tax-exempt interest, and include half of your Social Security benefits. If you're near the $25,000 threshold for individuals or $32,000 for couples, you need to pay close attention. Crossing those lines increases taxation. One strategy often discussed is Roth conversions. Converting funds from a traditional IRA to a Roth IRA means paying taxes now, but future qualified withdrawals become tax-free. Those withdrawals don't count toward provisional income, which can help manage Social Security taxation and Medicare costs. Another option is a qualified longevity annuity contract, or QLACE, which allows you to defer a portion of your retirement funds from RMD calculations until later in life. There are also qualified charitable distributions, or QCDs, which allow direct transfers from an IRA to a charity without counting as taxable income. Each of these strategies can reduce overall tax exposure when used correctly. Record keeping is another critical area. Keep all 1099-R forms, track after-tax contributions using Form 8606, and maintain documentation for Roth conversions. Without proper records, you risk paying taxes on money that was already taxed. Also, be cautious of scams. The IRS does not call, email, or message you on social media demanding payment. Any such contact is fraudulent. Always verify through official IRS channels. Looking at the bigger picture, this is happening during a major demographic shift. Millions of baby boomers are entering retirement, placing pressure on systems like Social Security. Policy debates are intensifying, with some advocating for expanded benefits and others seeking increased revenue. The outcome will shape retirement security for decades. Seniors remain one of the most influential voting groups, and their voices carry weight. Contacting representatives, asking questions, and staying informed all matter. Here's the bottom line. First, understand your numbers. Second, explore legitimate planning strategies. Third, seek professional advice if needed. Fourth, stay engaged with policy discussions. Fifth, remain alert to scams. What Sanders highlighted matters because it brings attention to a system that has gradually placed more pressure on retirees through inflation and complexity. Whether you agree with his broader views or not, the issue itself is real. You worked your entire life to build your retirement. You paid into the system. You made sacrifices. You deserve clarity and fairness. Stay informed, stay proactive, and protect what you've earned.